welcome everyone. We're going to get started. I hope everyone is having a great Thursday. So welcome to the Lumsden and McCormick webinar, Tax Planning in Uncertain Times. My name is Maria Gambacorda, and I will be your host for this webinar. This webinar is being recorded, and that way we can share a recording with all of you if you want to play it back. I'm gonna advance the slides here. So just to review the format for the presentation today. Oops, I think I went too much. Hang on a second. Oh, sorry about that. I'm not sure why is this. Anyway, I will keep going here. Polling questions. We are going to have four polling questions, so you'll be prompted. I hope each of you will participate, and then we'll share the results. Chat is enabled. You can type in your comments. They'll go to the panelists. The same with Q&A. We'll be taking questions throughout the presentation, so please ask your questions as you think of them. And at the end, you'll be prompted to take a survey, which will serve as an evaluation for anyone requiring CPE credits. Moving on to CPE, the session will allow for 1 hour of CPE credits. And we would ask that, again, you complete that evaluation. And if you would, please, my email is going to appear in the chat. If you could, please email me that you're looking for CPE credit, and I'll make sure you get a certificate following the event. The slide deck will be provided in a follow-up email as well as being on our website. And we do have some related content for this event. It is a technical articles spotlighting the individual tax matters as well as the proposed presidential tax plan. So you can review, there's 3 of them, and those will be as you can see, they just showed up in the chat. So thanks to Christine, a member of our marketing department, who's helping with the presentation today. So moving on to introductions. The presentation today will be done by 2 tax partners, Cheryl Jankowski and Mishi Needham. Cheryl has extensive experience working with business owners and individuals on minimizing taxes, and she focuses on estate and succession planning. Mishi is also an experienced tax professional. She works with, again, businesses and individuals to conform with federal and state tax standards. Mishi is also a referring advisor for Lumsden and McCormick Financial Services. So I am going to turn over the presentation to both Mishi and Cheryl. And again, if you have any questions, please use the Q&A to ask your questions. Thank you.
Great. Thanks so much, Maria, for hosting, and thanks, Christine, for being in the background and being supportive here. I will say this is a first for me, a Zoom presentation, but I think our first slide, as we move through the agenda, we're going to kick off the presentation with a polling question. And Maria, do you know when do we get the results, or can we move on? And the results are a staggering 55% yes for the Bills. I absolutely agree. We will make it to the Super Bowl. Why? Because only Buffalo will make it to the Super Bowl in a pandemic. So we get that little asterisk next to our win, saying that there was not full talent playing on every team. So that's why we won. That's why I think we'll win the Super Bowl. But anyhow, moving on to the CARES Act. So this morning we will be discussing some of the beneficial tax provisions of the Coronavirus Aid, Relief, and Economic Securities Act, also known as the CARES Act. So on March 27th of 2020, President Trump signed the CARES Act, which put into place the 3rd phase of legislation that was designed to deliver speedy relief to businesses and individuals who are struggling due to the COVID-19 pandemic. It is the largest stimulus package in history with an estimated cost of $2.2 trillion. So let's start off by reviewing some of the important tax provisions related to individual taxation. So required minimum distributions for taxpayers who are 70 and a half or older, they're required to take a minimum amount out of their retirement plans each year. The CARES Act has temporarily waived the RMD rules for certain defined benefit contribution plans and IRAs for 2020. This provision obviously came out later in the year, so taxpayers may have already taken out some R&Ds at the beginning of 2020. The provisions did allow for a 60-day rollover back into the retirement plans, and then you would not be taxed on that. They further extended that provision to allow any taxpayers that had already taken out their 2020 RMDs to be able to roll them back into the plan by August 31st of 2020. But if you're more of a fourth quarter RMD taxpayer, you haven't taken out your RMD yet, here's where some planning opportunities for you exist in terms of looking at whether you really need to take that cash out for your individual tax purposes, or is it better left in the plan? You can get cash from a different area, different account. You may not need it. It also serves to reduce your 2020 income tax liabilities, and it also, because your RMDs play into your overall taxable income, it could affect how your dividend, your qualified dividends and your capital gains are taxed, as well as how much your Social Security may be taxed. So it's a nice discussion point to have with your tax advisor to see if this is really something that you may need to take in 2020, or if not, what would be the tax benefit of not taking it in 2020. The waived RMDs are not required to be taken in subsequent years, so it's not as though you're going to have to double up in 2021 if you chose not to take the RMD in 2020. The CARES Act also has a waiver of early withdrawal penalties. So generally it removes the 10% penalty on an early withdrawal from a retirement account during 2020 for a coronavirus related distribution of up to $100,000. Now there's several requirements that must be met for this distribution to be considered a coronavirus related distribution. And I'm not going to get into all those this morning, but if you or a taxpayer was affected by the coronavirus, or a family member, this may be something you may have needed to do or may need still to do. The taxpayer does have the option of reporting the distribution as ordinary income ratably over the next 3 tax years, including 2020, or they can recontribute it back to the retirement plan within 3 years and avoid tax altogether. So if you do think that you fall into potentially having to take out an early distribution for a coronavirus related situation in your family, feel free to reach out to your tax professional and we can give you all of the specific guidelines on that. CARES Act has also changed some of the charitable contribution provisions. Individuals that itemize can deduct cash contributions of up to 100% of their adjusted gross income. So the Tax Cuts and Jobs Act previously increased this limitation from 50% to 60%, and now it's up to 100%. But just note that this is for cash contributions only. It is not for stock contributions, any type of in-kind contributions, and it cannot be a contribution made to a donor advised fund. Those are not eligible for this incentive. Individuals who do not itemize can claim an above the line deduction of up to $300 for a cash contribution to qualified charitable organizations. Again, it cannot be a donor advised fund. So if you've been holding back, or if you have a charity of choice, this may really be a good win for both you and the charity come the fourth quarter. So that'd be a great planning opportunity. So the Tax Cuts and Jobs Act, the provisions stated that net operating losses generated in tax years beginning in 2018 and later tax years could not be carried back and can only offset 80% of taxable income in carryover years. I'm not going to give you any examples of numbers in terms of how that all works, because right now it's gone. They're temporarily waiving that, but the TCJA also allowed for NOLs to be carried forward indefinitely, and that still sticks. The CARES Act now permits that the NOLs from 2018, 2019, and 2020 tax years can be carried back to the previous 5 tax years, beginning with the earliest of the first tax year. It also suspends the 80% of taxable income limitation through the 2020 tax year. So again, this is only temporary. It goes back into effect for 2021 NOLs as of now. Taxpayers can elect to waive the loss carryback claims if it's if they find it's more beneficial for them to carry it forward. But taxpayers cannot elect to reduce carryback period. So you can't just pick and choose and say, I only want to go back to 2 years and carry the rest forward. You have to go all the way back to that very first year. So the 5 years does apply. And depending on the taxpayer situation, an NOL carryback can result in cash flow benefits if you're needing a bump up in your cash flow. It also has the benefit of potentially a permanent tax savings by using losses to offset income generated prior to the TCJA when the tax rates were much higher. So if right now the top rate is 37%, but your tax rate in the year you're carrying it back was 39.6, you could be realizing some permanent tax savings. So it's beneficial to do the analysis and see what works out best for your specific situation, because there are definitely some things that come into play when looking at, deductions and other things that we're taking in previous tax years. So it may not always be a slam dunk that your effective tax rate times your NOL gives you all of these great tax savings. It would also be beneficial to pursue planning measures to accelerate deductions and defer income in order to increase an NOL in the 2020 tax year if you are looking to carry that back as well. So between now or in the last quarter of 2020, these are some great things to be thinking about to be able to take into account these benefits that the CARES Act are giving to taxpayers. But what I will say in terms of the cash flow, as I previously stated, that this was supposed to be a speedy way to get cash flow to taxpayers. Not so much. The IRS has not been quick in processing or even releasing cash. It hasn't even really been quick in processing or releasing 2019 tax refunds for tax returns that have been filed. So while these are great planning opportunities, you definitely will not see a 6-week turnaround in terms of getting back your carryback claim cash. The TCJA also limited individuals from using more than $250,000 for single filers and $500,000 for married filing joint filers for business losses to offset non-business income. So for example, if you're a Schedule C or a pass-through entity and your business in 2018 had a loss of $700,000, you could only, as a married filing joint return, you could only use $500,000 of that loss to offset non-business income, such as investment income or capital gains. So if in the year where you had the $700,000 loss, you had a $600,000 capital gain, you would only be able to use $500,000 of that loss against that gain. You'd be taxed on $100,000 of the capital gain, and the $200,000 of the loss would go into your NOL pool and be carried forward into 2019. So it was never lost, it was just limited. And even though your overall loss exceeded all of your income, you were still limited on what you were able to take. Well, the CARES Act has repealed that limitation for 2018, 2019, and 2020 tax years. This repeal is non-elective, so the taxpayers that did have an excess business loss limitation in 2018 or 2019 may need to amend their tax returns to claim that loss, regardless of whether doing so is favorable to them or not. For instance, in the example that I gave, this taxpayer used $500,000 of their business loss against capital gain income, which is taxed at a lower rate, and therefore carried forward the $200,000 that they were planning to be able to offset ordinary income in the 2019 tax year. Well, now with this repeal and the limitation no longer existing, the 2018 tax return would have to be amended to allow for that $700,000 loss to completely offset the $600,000 gain and carry forward a $100,000 loss into 2019 as an NOL. So it could result in some tax refunds to the taxpayer, but it also skews the tax planning that may have been done to be able to use that, and then also estimated tax payments that may have been projected as well. So because of this retroactive nature of the repeal, it's left some unanswered questions, and as tax practitioners, we've been seeking additional guidance from the Treasury on how all of this is going to play out, since it was so retroactive in nature in terms of having 2 full tax years closed out. And in the middle of preparing the returns for 2019, you now have this thrown at you, and it really skewed things. So there's more information coming out on how and when to amend these returns. But these limitations will apply again beginning in 2021. So definitely careful tax planning and looking at your past tax years and how those years may affect also your 2020 tax returns would be important. And then finally, which is probably old news to most, but these recovery rebates, also known as the stimulus checks, they were given to U.S. resident individuals who were not dependents. They were eligible for $1,200 or $2,400 if you were married filing joint, plus $500 for each qualifying child who had a Social Security number. The rebates were also phased out as of a certain point of taxable income. So there was a threshold that you had to meet. And then if you went over that threshold, your recovery rebate may have started to phase out. Again, based on timing, not everybody had their tax returns in. So a lot of taxpayers, their rebate may have been calculated based off of your 2018. Will that make you have to pay it back if maybe you got more rebate than you should have if you used your 2020? Certainly will not. They say you will not have to repay back any rebates that you received in excess. What will happen on a taxpayer's 2020 tax return is this will be reported as a as a refundable tax credit. For most people, it'll just be an in and out since you've already received the money. Had you not received your money, then if you've not received the money, then you would get the credit on your 2020 tax return as a refundable credit, and you would get it at that point in time.
I'm going to interrupt. We do have a question. I believe, Misha, you just answered it. It said, what happens if I get a rebate and wasn't supposed to?
If you got a rebate and you were not supposed to, in terms of whether you were, I guess I'm wondering if the question is if you were a dependent in 1 year and not another year, if that is the question, because most taxpayers who file the tax return should be getting a rebate. But again, once you go to file the return, the guidance right now says if you got more based on the information they used to issue the rebate, then you would not have to repay it back. Obviously, like all of this, it could be subject to change once they realize, you know, I've had clients who were deceased in 2018 and they were sent a rebate check. So, you know, those ones should be returned, obviously. But if I haven't answered the question, please feel free to reach out, you know, with more specifics, and I can give you a better explanation. Okay, so the CARES Act provisions, these are, again, like I said, these are all temporary in nature. So we definitely encourage you to discuss these opportunities with your tax advisor and how they may affect you for 2020 or even the prior tax years in which some of this for individuals has become retroactive. So now I'd like to review some of the important tax provision changes that are related to corporate taxation. This is not necessarily S corporations, this is more C corporations who are actually taxable entities. So the qualified improvement property, which we like to call QIP around here. So the TCGA created this retail glitch due to a drafting error causing qualified improvement property to have a 39-year recovery life instead of a 15-year recovery life. Therefore, it made QIP ineligible for the 100% bonus depreciation in 2018 and 2019. We're holding our breath for a really long time, waiting for them to fix that retail glitch, and they never did. But the CARES Act retroactively corrected the drafting error for QIP that was acquired and placed in service after January 1st of 2018. So the planning opportunity for taxpayers that may have had QIP, and again, I'll just give you a brief, QIP is non-residential, internal and non-structural improvements. Think about tenant improvements, things that are movable within the building, they're not permanent. That would be what your qualified improvement property would be. So the planning opportunity for taxpayers here would be the ability to accelerate this depreciation, either by filing a 3115, which is an application for change in accounting method, or by filing an amended tax return. So what the CARES Act, when the CARES Act came out, we were kind of in the middle of our tax season. So had you not filed your 2019 tax return, the CARES Act allowed you to make that accounting method change on your 19 return for both your 18 and your 19 tax returns and pick up all of that change in 2019. But had you had already filed both your 18 and 19 tax returns, then you would amend if you would find that QIP would be beneficial for you. But also keep in mind that the 100% bonus depreciation that you can take on the qualified improvement property, you can take bonus depreciation in excess of taxable income and therefore create an NOL. And now with the ability to carry back the NOLs, this might be an opportunity for some taxpayers to go back and look at, what is the magnitude of the QIP that they put into service, and can we create an NOL and carry it back? The other thing to note is that many states, including New York State, do not allow for the 100% bonus depreciation in the year that it's taken for federal tax purposes. This could create some tax leakage at the state level, but you will be able to take that depreciation for state purposes over the life of the asset versus that first year, big 100% bonus depreciation. Also noting that bonus depreciation isn't going to be around forever. It was scheduled to start slowly ticking down before the TCGA, and then the TCGA put it back at 100%, and it is supposed to start phasing back out in the future tax years. So there's an opportunity there for some accelerated depreciation. Moving into the business interest limitations, also known as 163J. So the business interest limitations was added by the TCGA, and it generally limits the deduction for interest expense. There is a whole calculation in which there's a sum of a bunch of things off your tax return. I'm not going to bore you with those details right now because they're not on the slide. But there's a limitation on how much business interest that you can deduct in a tax year based off of this calculation. There are certain small taxpayers that would be exempt from the limitation, and also electing real property trader businesses are exempt from the limitation if they make the election to be a real property trader business. but they would be required to slow down their depreciation on real property. So there's a trade-off there, and you probably want to do the proper analysis to see if it's more beneficial to elect out of it and take the slower depreciation, or be subject to the limitation and take your depreciable life over, let's just say 27 and a half years versus 30 or 40 years that you would have to. The CARES Act increases this limitation. It was under TCJA, 30% of your adjusted taxable income would be your limitation. The CARES Act uses a 50% of adjusted taxable income as the limitation. So it's not completely going away, but they're making it easier for you to take a little bit more of your interest expense deduction. It doesn't go away, it's carried forward, and it goes back into the calculation each year. But if in 2019 and 2020, you're able to use this increased limitation, there's a possibility of creating an NOL. And if you can't get to that point, you're at least reducing your taxable income by being able to take more of, but not 100% of your business interest expenses. Taxpayers can also elect to use their 2020 adjusted taxable income in computing their 2020 limit. This would be providing relief to those with incomes that are going to be in a decline for 2020. So you have the option, it's an election, you don't have to use 2019 and 2020, but you do have that option. So the proper analysis of whatever is going to maximize that amount of your allowable business interest expense should be done, just to give you an idea of what that limitation would do. And again, small businesses, this would not affect you, but real estate businesses, and generally if your gross receipts are over 25 million, this would affect your tax calculations. Moving into the net operating losses and the 80% limitation. So I touched on this earlier under the individual provisions, but it's the same for the corporate tax provisions as well. There is temporary relief given for the tax years of 2018 through 2020. In which you can carry back 5 years, but you still have the infinite carry forwards. And finally, with minimum tax credits, the TCJA, it repealed the corporate alternative minimum tax and provided an opportunity for corporations to claim a refund of the minimum tax credit carryovers during the 2018 through 2021 tax years. The CARES Act makes any remaining minimum tax credit carryover fully refundable in 2019. If you still have those lingering, those can you open up the floodgates and you can get them in 2019. Alternatively, corporations can elect to claim the refund for the unused carryovers in 2018. That might be an option for fiscal year filers if that comes before their 2019 return may be due. So these are all temporary provisions, and proper planning and analysis, again, it will need to be done to make sure that these are as tax beneficial to the corporate taxpayers as possible. Again, we're in the fourth quarter, so it's a good idea to eyeball these and see if any of these would apply to you. Corporations are their own taxable entities. Partnerships are pass-through entities where the partners are subject to the income tax on the taxable net income of the partnership. But there are some elections and decisions that are made at partnership levels that affect the partners. So I just wanted to briefly touch on the fact that partnerships, they are also eligible for the retroactive change to QIP for the qualified improvement property. The business interest limitations do apply at the partnership level and are passed through to the partners. The CARES Act does not provide entities, taxes, partnerships any relief for the 2019 business income, the business interest expense limitations. I think that's mostly because when this all came down, we were right in the middle of the March 15th deadline. And you can imagine the amount of amended returns that would have had to gone through if you were to have this apply to partnerships for 2019. But the partnerships can use the reduced limitations that I discussed earlier in the 2020 tax year with the election of using either their 2019 ATI or their 2020 ATI. And finally, the partners of the partnerships, if they did have excess business interest limitations passed through to them for 2019, they will be able to use 50% of that excess business interest as an allowable deduction in 2020 without limitation. So if you had $50,000 of excess interest that you weren't able to take in 2019, you would be able to take 50% of that as a 100% deduction without it going into your 163J calculation on your 2020 tax return as a partner. But again, these are ultimately timing differences. So we also want to make sure that, we're making the right decisions and not just the right decision for one tax year, but for your future tax years as well. So we are going to move on to our next polling question. Did you receive a PPP loan? And 68% of our audience has. I would say that many of my small, mid-sized businesses also receive the PPP loans as well. And one other before I go into the PPP loans and how it's going to affect your taxable income, just wanted to note in terms of state and local tax relief in regards to the CARES Act provisions, there aren't any. New York State cannot afford the favorable tax provisions in the CARES Act and has elected to decouple from the CARES Act. So New York State will still be implementing the TCJA tax reform in regards to excess business loss limitations that I discussed earlier, excess business interest expense limitations, and also QIP. Interestingly enough, you would think, well, New York State doesn't allow bonus depreciation, so it's the same thing. Well, New York State is saying we decouple, which means that you cannot depreciate your QIP over 15 years for New York State purposes. You'd have to use the 39 years that's written into the TCJA. Will that change? Hopefully. Right now we don't know, but it's just creating a lot of uncertainty and some new layers of complexity with respect to the CARES Act and planning for state income taxes. And now I'd just like to touch briefly on PPP loans. I'm not going to go into any of the monstrous details of these loans. We have a great expert team here in-house, Megan Morris and Jenna Torella, who gave us a great seminar a few weeks back on this. But for tax purposes, obviously, as it's been touted all along, is that the forgiveness or cancellation of these loans is to be excluded from gross income for tax purposes. After these loans were advertised and applied for, the Treasury came out with notice 2020-32 that stated you cannot deduct business expenses used from forgiven loan proceeds. Essentially, the IRS is saying there's no double dipping. That's definitely not how this program was sold to these small businesses. It was basically keep your people on payroll and out of the unemployment lines. And not that you're going to end up with a big tax bill because you decided to keep your workforce intact. There are definitely senators and congressmen that are pushing back, on what the Treasury has put out here, and we're we're hoping for a favorable outcome in which these business expenses, payroll, and also the other eligible expenses will be able to be taken as a deduction on your 2020 tax returns. Just so that there aren't any surprises as we wait for all of this to shake out, it may be prudent for you to do a tax projection just to understand what your tax exposure may be if the Treasury decision is not overruled, and you won't be able to take a deduction for those business expenses. So in conclusion, seize the opportunities that may be available from these CARES Act provisions. Taxpayers could realize tax savings, but again, the actual cash flow from the IRS has not been quick or timely. It'll get to you eventually, but just not in a quick turnaround manner. Several of these areas, there's still unanswered questions. The IRS will absolutely continue to release guidelines over the coming months. Congress may also modify certain rules in the upcoming COVID 2019 legislation. State conformity will likely evolve over the coming months as well, as our state legislators start to take action and respond to this pandemic in whole. So with that, if there's no further questions for me, I'd like to pass the Zoom mic to Cheryl to give us a rundown on the proposed presidential tax plans.
Before we move to Cheryl, Michie, we do have a question. I don't know if you could see it in the Q&A there. If not, I'll read it.
So the question is, the verbiage of that statement for PPP forgiveness was difficult. Are you saying that a tax rate will be applied to the PPP loan, or the full loan will be required to be paid back? So right now, the regulations, any portion of the PPP loan that is forgiven, now if the whole loan is forgiven or only a portion, so only the whatever is forgiven, the loan is excluded from gross income, but the expenses that were the expenses that were incurred that you use the funds for, those would not be able to be taken for tax purposes as the notice states right now. So if you took out a PPP loan for $100,000 of payroll costs, you used it all for payroll costs, you get that $100,000 forgiven, you will not get a cancellation of debt 1099, but when you go to file your tax return, those $100,000 of payroll costs will not be able to be taken as a deduction on your tax return. Great. Oh,
thanks, Michie. As you can see, the CARES Act.
I'm sorry, we do have another question on the PPP loan.
Certainly.
The question is, the money received from the CARES Act Provider Relief Fund treated the same as the PPP loan for tax purposes? I think I would have to take this one offline. I don't know that I'm familiar enough with the Provider Relief Fund to answer this. So Laura, I can take this one offline.
Okay, we'll move ahead then to Cheryl. Thank you for your questions, everyone. Keep them coming and we'll answer them as they appear in the Q&A box. Thank you.
Thanks, Maria. Michie, great job talking about the CARES Act. What makes me kind of laugh is when when Trump was touting his proposals before his election way back when, he was talking about that it was going to be tax law simplification. And I will tell you, when the Tax Cut and Jobs Act passed in 2017, I would think that most tax advisors would tell you that there is nothing simple about what was passed with the Tax Cut and Jobs Act. And then with the decoupling of CARES during the year, which is great, great legislation, really is going to help a lot of our business owners and such. But then New York State decouples, because it is such a costly program, it certainly makes things even more challenging when we're planning for our clients. So what I wanted to do today is talk about the Biden proposal and where Trump is on his proposals as well. But I think in order to really have a good conversation today, we really need to frame the conversation about when do we see major tax legislation? And it really depends on, as you can see from the slide, if you have the president, Senate, and House all with the same party, that's generally when we will see major tax legislation change. So, you know, the Tax Cut and Jobs Act, the Senate was Republican and the House was Republican when that passed back at the end of 2017. That has switched since, and the House is now controlled by the Democratic Party. So, you know, a couple of the highlights of some of these major legislations over the years, you know, the Clinton Deficit Reduction Act, we got to see a 39.6% top rate. That was also when the cap on the Medicare of your tax of 2.9% or 1.45% for employees. There used to be a cap on how much Medicare tax you paid, and that went wayward back in 1993. The Obamacare legislation, that was back in 2013 when we were introduced to a new concept called the net investment tax, which is an additional 3.8% tax on your net investment income. And interestingly enough, that kicks in for single individuals at 200,000 and married individuals at 250, and that's not indexed for inflation. So more and more people since 2013 have been getting, most likely just because of inflationary pressures, paying the net investment tax. Now the Trump Tax Cuts and Jobs Act, what's interesting is anything in red, those were tax cuts, and they, for the most part, were considered temporary. So the Tax Cut and Jobs Act, that is set to expire for the individual provisions as of 12/31/2025. So I just wanted to mention that. So really, when we talk about the Biden proposals, if Biden is elected, maybe on November 3rd, maybe we'll know for sure, who knows. But the Senate also goes Democratic. The House will probably, you know, folks believe it will stay Democratic. If you got all three in blue there, there could be some major legislation passing. So Maria, I don't know if you wanted to pull up the polling question.
People are answering, so we'll give it a few more seconds here. Seems to be a popular question.
For all set, Maria, we could advance to the next slide. Great. So one of the areas that we thought we would touch on is different areas, the estate taxes, personal individual taxes, and corporate/business planning. So from an estate planning perspective, the Tax Cut and Jobs Act enhanced the estate and gift exemption significantly, up to $11.58 million for 2020. That gets indexed for inflation every year, so it'll be higher than that for 2021. And when somebody passes away, one of the key things that we focus in on is that that decedent's property gets adjusted to market value as of the date of death. So we don't care anymore if they bought Apple stock for $1 and it's worth $400 a share. To those individuals that inherit it, it's worth $400 a share to them. Now this law is considered temporary, and it's set to revert to the pre-Tax Cut and Job Act level of 5.8 million or so in 2026. So one of the things we've been talking to our clients about since 2000 and pretty much end of 2018, if they have the wherewithal to consider making significant gifts during their lifetime. I'll just mention in passing that New York State, of course, has its own level of estate tax, and that's at about 5.85 million for 2020. And the New York and the federal laws are very different. So if you're in that area of wealth, please feel free to reach out to an advisor just to chat about planning opportunities for yourself or for clients. Now, Biden's stated goal is from an estate planner, to me, is a little alarming. He's talking about reverting those $11.58 million, I refer to that as the enhanced exemption, back to the 2026 level, so about half of that. And this is a key thing: eliminate the current step-up in basis on inherited assets. That would have some significant impact on planning for our clients. There's so many times where one of the strategies for our clients is to hold on to assets until they pass to get the step up in basis. So that's something that certainly would keep my eye on if Biden in both the House and the Senate go Democratic. Now, Bush, you have to think, you know, most of my presentation today is going to say, excuse me, I keep on saying Bush for some reason. Maybe after Tuesday's debate, I maybe wished it was Bush instead of Trump up there. But so Trump's stated goal is that, you know, he was part of the Tax Cut and Jobs Act in 2017, and he likes them. So he'd like to extend that exemption. You know, from a practicality standpoint, it certainly gives taxpayers a lot of certainty instead of monkeying around with these exemptions going up significantly and then potentially going backwards. And that step up in basis would continue if Trump were elected president. Next slide, Maria. So individual tax rates, you know, the Tax Cuts and Jobs Act significantly lowered many brackets. The top bracket pre-Trump was 39.6%. It was lowered to 37%, but there was many other of the tax brackets all decreased under the Tax Cut and Jobs Act. Biden would move that back up to 39.6% for taxable income over $400,000. And whether he would increase the rates for the lower income levels would remain to be seen. Now, Trump's goal would be to keep the status quo, and he would like to add some additional cuts for middle-class taxpayers as well. So overall, I think what you're going to see, the theme of my discussion today, anytime we have a Biden goal, it's probably going to be to raise revenue. And that's pretty much as we go through these proposals, what that looks like. You can go forward, Maria. So capital gains and dividends. Currently, the top tax rate for long-term capital gains, that's assets held over 1 year, and qualified dividends is 20%. And a lot of times taxpayers think that that 20% bracket, it kicks in much earlier, and that's why I wanted to highlight this today. For individuals at 441,000 is when that lower, that higher capital gain bracket kicks in. Normally, the capital gain bracket can be as low as 0%. Generally speaking, it's 15%, but for higher income earners, it's 20%. And as I mentioned before, that 3.8% net investment tax kicks in at a much lower level, $200,000 for individuals and $250,000 for married filing joint. Those are not indexed for inflation. The capital gains rates are, though. Now, Biden's stated goal is that he would eliminate that break for capital gains and qualified dividends for income above $1 million. So those qualified dividends and long-term capital gains would be taxed at ordinary rates. So instead of paying tax at 20% plus a 3.8% net investment tax for those individuals, or 23.8%, they could be paying upwards of 43.6% for long-term capital gains and qualified dividends for individuals whose income is over $1 million. If you add that to our state tax rate, which is over 8%, and if you live in the New York City area, you're talking well over 50% of your income could be going to taxes. Now, Trump's stated goal is that he would like to reduce capital gain tax rates and index capital gains for inflations. I might have to retire if they do that, because I think that would add tremendous amount of complication overall, and then have a capital gains tax holiday that would eliminate capital gains for a period of time. Some of the theory behind this is we're paying tax on things that are purely inflationary. So if I use my Apple stock example again, and you purchase it for $1 and you've held it for 10 years and now it's worth $400 a share, some of that gain is related to purely inflationary. Some of it, of course, is how the corporation has performed over the years, but that's the theory behind these lower capital gain rates. So Maria, I think we're oops, sorry, I jumped ahead in my, so itemized deductions, part of the Tax Cut and Jobs Act, although they were talking about simplification, when it came to itemized deductions, for most taxpayers, their tax returns did become simplified. What the Tax Cut and Jobs Act did was it significantly increased the standard deduction and it eliminated personal exemptions. In addition, the Tax Cut and Jobs Act eliminated things for miscellaneous itemized deductions, such as investment management fees, home office expenses, employee business expenses. And it also capped the SALT limitation. SALT is a state and local tax deduction to $10,000, whether you're single or you're married. And that was significant changes for itemized deductions. So a significant number of our clients no longer had to itemize for federal purposes. However, New York State thought they were being generous, and they still allow individuals to itemize for New York State purposes. So although we cheered for about a nanosecond here that we thought that individual tax returns were going to be simplified, we still have to pull a lot of this information together to see if we can take the standard, or excuse me, itemized deduction for New York State. Now, one thing I just want to mention about the SALT deduction in New York State taxpayers, limiting our state and local income tax deductions to $10,000 really stinks, quite honestly. My property taxes alone, and just got the school tax bill, they're pretty close to $10,000, and many clients are in excess, and that's not even adding our state income tax to it. The reality is, because we live in the great state of New York and we pay a lot of taxes between property and state income tax, a lot of taxpayers fell into what is called the alternative minimum tax. And so essentially, I never got any benefit of those property taxes or my state income tax. So when the Tax Cut and Jobs Act passed, at first, a lot of us thought, boy, we're going to be really hurt by this legislation. And the reality was, we really weren't hurt at all. And with tax rates going lower, we actually benefited. Where I saw the real pain for clients were clients that had high wages, or mostly the high wages, because if you had a business, you kind of lucked out on this qualified business income deduction, but high wage earners really were clobbered because most of the time they were not in the alternative minimum tax, and so they saw a significant increase in their taxes. So Biden's stated goal is that he would like to, have a lot of those itemized deductions back, but he would like to limit them to a certain level of benefit to 28%. And although Biden hasn't proposed removing the SALT cap, it's already passed in the House of Representatives, and our Senator Chuck Schumer has pledged to repeal that cap as well, because the SALT cap hurts the blue states the most. So if we have Democratic controlled House and Senate, that would be something that I would think that we would see very quickly. Now, Trump's stated goal, again, is that he would like to make these permanent, since the Tax Cut and Jobs Act is considered temporary. But as you can see, is anything really temporary or permanent when it comes to taxes? It really only takes control by one party, and things change very quickly. Another area of potential tax increases under the Biden proposal is under Social Security taxes. Now, currently, as an employee, you might pay 6.2% on your wages up to $137,700 of income for 2020. That gets indexed every year for inflation. What Biden has proposed is that once you get back up over $400,000, that 6.2% will kick back in. So there could be a significant Social Security tax increase to employees with wages over those levels. Now, Trump, you may have heard about his executive order that he passed in August because the Senate and the House couldn't agree on a bill to pass. So he temporarily postponed Social Security taxes for employees from September 1st through December 31st. So essentially, if the organization that an employee works for decided to participate and postpone these, the individual employees, unless this is going to be considered permanent, they'll have to repay those postponed taxes in 2021. I did a quick Google search, so you know if I Googled it, it must be right. The federal government, a lot of their agencies did elect to postpone the Social Security tax. However, a lot of private businesses, even state governments, colleges did not go along with this postponement opportunity, we'll call it. So it's interesting that not all taxpayers are benefiting or from Trump's executive order that he passed. So Maria, if you want to put up the polling question, thank you. So another area of individual taxation that Biden has proposed. So currently, there's a child tax credit for individuals whose income is, you get the full credit if your income's around 400,000 or less. There's a $2,000 child tax credit for dependents that are under the age of 17. And you get an additional $500 credit for those individuals that are 17 and up. You're thinking, why 17? Well, some children are actually in college at 17. So that was the theory by dropping it at that age range. And then there's a dependent care credit as well currently of $600 per dependent. Now, Biden's stated goal would be to increase the child tax credit to $8,000 per dependent. Wow. That might incentivize some folks to have more children. $16,000 for 2 children, so that's an extremely generous goal there. On a side note, it was tough to get the $2,000 child tax credit through back with the Tax Cut and Jobs Act back in 2017, and Marco Rubio held out for a while until he was able to get that provision through. So just a little color commentary there. So it'd be interesting to see if everybody would go along with those really very generous goals. And Trump, of course, you know, he likes his Tax Cut and Jobs Act, and he would like to extend it past 2025. So let's talk a little bit about corporate tax rates, AMT, and real estate. Current law, significant changes were made under the Tax Cut and Jobs Act, which now we have a flat corporate rate of 21%. The theory behind that was that across the entire world, our US corporate tax rates were significantly higher than other nations. So they resulted in a flat 21% tax rate. They eliminated the alternative minimum tax, and these tax changes do not expire. These are considered permanent, but they're only as permanent until you get a major change, and they will change probably at some point. So Biden would like to change that flat rate up to 28% and then have some corporate, there'll be potentially some even higher taxes for corporations of $100 million or more of profit. One of the biggest areas of concern from our perspective as planners is Biden would like to limit this qualified business income deduction for individuals. What does that mean? It means that for those businesses that operate as pass-through entities, such as partnerships and S corporations, they receive a 20% deduction against their taxable income if they meet certain hurdles, of course, because nothing can be really simple. And they're able to reduce their taxable income. So that effective 37% tax rate is much lower. It's closer to 31%. And the theory behind that was that if corporate rates are 21%, then businesses that are taxed as pass-through entities, those businesses should receive some of the same benefits. So we have this qualified business income deduction. Biden has proposed that for individuals that have $400,000 of less of business income, that would be allowable, and those businesses with more would not be allowed this deduction. So that could be a huge tax increase. And you might say it's at the individual level, but really the taxes are paid by the partnerships and the S corporations because they make distributions out of those entities out to their shareholders or partners to pay the taxes. So it would be a bigger drain on these companies because more of those distributions to their shareholders or partners will be going to pay for taxes. Now this one, I don't know if, this is a really nasty proposal here about the potential to eliminate the Section 1031 like-kind exchanges. What this means is that oftentimes our real estate owners, when they go to sell a piece of real estate, they may have a very large gain. And they have an opportunity to park the money with a qualified intermediary and purchase another property of like kind, and they defer that gain. And a lot of taxpayers, the strategy is you keep on deferring that gain, and someday when you pass away, you'd get a step up in basis. Well, I mentioned before, one of Biden's proposals is to eliminate that step up in basis. And if he also did this, like-kind exchanges are no longer available to taxpayers, I would think there would be a significant hit on our real estate market because of that inability to exchange real estate and defer that gain. In addition, there's for lower income individuals, not low income, but lower income individuals, if they have rental real estate and it has a loss, they're able to deduct up to $25,000 of that loss on their tax return. And that under Biden's proposal could be eliminated as well. Trump, his stated goals is he has not announced any changes with regard to corporations or QBI. I'm sure he would not be in support of eliminating the Section 1031 like-kind exchange opportunity either. So it really is dependent if we end up with a sweep of the Democratic Party come November 3rd. So let's just talk about some tax planning with a Democratic sweep. One of the key things we've been working with our clients for most of the year is if they are in a taxable estate situation is looking at additional lifetime gifts. $11.58 million is a lot of money to be transferring to maybe the next generation. And we want to make sure that there's very thoughtful planning. So if you're in that situation, we should be having conversations now. We certainly don't want you to say, well, I'll see if the Democrats all get in all the House, the Senate, and the presidency, because to get thoughtful planning done and documented by December 31st is going to be very challenging. And why do I say you might want to get it done during 2020? Well, even if tax changes, a tax law is implemented in 2021, it could be retroactive to 1/1/2021. So some of these opportunities that exist now may not exist in 2021. And when we talk about transferring great amounts of wealth, there are many, many different planning vehicles that we use for clients. And that's not the focus of our discussion today, but we would explore those with anybody that's in that situation. From an income tax perspective, what are some things that we want to consider? Well, first of all, I want to say, don't let the tax tail wag the dog, because sometimes we want to make sure we're making a good decision and not just being concerned about reducing the tax liability. However, accelerating long-term capital gains when we know that the top capital gain rate is 20%. So sometimes clients say, well, I'll just sell it in early 2021 because I don't want to pay the tax this year. Well, if we have a Democratic sweep, you might want to consider accelerating that gain. In addition, one of the things we talk to our investment advisors about each year is whether there's any capital losses that they can harvest in the portfolio. Well, if we do have higher tax rates in the future, delaying harvesting those long-term capital losses that are now currently taxed at 20% and could, depending on what level of income you are in, could be taxed at 39.6 plus that 3.8% net investment tax, you might want to hold off harvesting those losses until 2021. If Biden were to get in and they made some significant changes, a lot of times clients are willing to live with the risk of holding concentrated positions of securities to get the step up in basis. You know, if these proposals were to go through, there really isn't going to be the potential step up in basis in the future. We might want to take a look at selling some of those positions. There's a lot of strategies that you can potentially implement in order to minimize some of the gains or spread them out over a period of time that we would want to explore. So if you were in that situation, please reach out to your tax advisor. Mishi mentioned before, charitable contribution deduction limitations. You can deduct cash contributions up to 100% of your adjusted gross income this year. So, you know, if you want to save tax dollars and you have philanthropic intent, 2020 would be a great year. We have been strategizing with clients because of the enhanced or those generous standard deductions now that we consider bunching charitable contributions. So this might be a year to do that. And the final note is Roth IRA conversions might make sense in the right situation. So if it's something that you've been considering, please reach out to one of your tax advisors and we can walk you through that. Now, on a couple, I didn't add anything with regard to corporations, but I just wanted to mention for a cash basis corporations, a lot of times we encourage our cash basis corporations to pay all the expenses that they can by December 31st and defer the income. However, if my crystal ball was clear and I knew tax rates were going to go up in 2021, those tax deductions would be far more valuable in 2021 than they are today. The other area is in depreciation. As tax advisors, we probably are making a lot of decisions and, you know, discussing with our clients about the depreciation rules. There's a lot of accelerated depreciation options. However, if tax rates were going to go up significantly, maybe we wouldn't want to be as aggressive in writing things off immediately and might want to slow them down. So just some food for thought if we have a Democratic sweep, and I'm sure there's going to be a lot more if that does happen. But a couple takeaways today, you know, we know what the rules are for 2020. So if you have some planning that you want to discuss and take advantage of, we know how that's going to probably end up. I put probably because they're, you know, Nancy Pelosi just proposed a $2.2 trillion bill that, you know, could change some of the things we talked about today. Unless there's a clean sweep, it's not likely that we're going to see major tax changes in the future. So if the Senate stays Republican and the presidency and the House are Democratic, they're going to actually have to negotiate deals to get through. So less likely that these changes that I've discussed with regard to Biden would be completely passed. And, you know, that Tax Cut and Jobs Act is those tax provisions or tax cuts are set to expire at the end of 2025. So thank you everyone for taking the time and listening to us, and we ate a little bit into your lunch hour today, so we certainly hope that you can enjoy this. If you have any questions for Mishi or I, we're glad to entertain any questions or reach out to either one of us directly.
Thanks everyone for attending. I'll follow up with emails regarding CPE as well as the slide deck if anyone is interested. Thank you.
Thank you, everybody.
Thanks.